So, there's this huge change coming to the world of finance, and it's called IFRS 18. Honestly, it's about to completely reshape how companies report their performance. And if you're an investor or a business leader, you absolutely need to know what's coming. Let's break it all down.
You know that feeling when you're looking at a press release and you see a headline number like adjusted EBITDA or underlying profit, and you can't help but wonder, what exactly did they adjust out of that? Are we seeing the whole picture or just the pretty parts management wants to show us? Well, that question is exactly what this new standard is all about.
So before we can really appreciate the solution, we got to talk about the problem. And right now, let's be honest, for a lot of people, financial reports can be, well, a confusing mess. What's the core issue? It's really a lack of consistency. When every company has its own special recipe for profit, trying to compare them is a nightmare. Important details just get buried in vague buckets like other expenses, and the math behind those custom numbers, a total black box.
It really is like a financial Tower of Babel. One company's operating profit includes things that another company would never dream of putting in there. This forces investors to waste so much time just trying to decode everything and get all the numbers on an apples-to-apples basis. It shouldn't be this hard.
Okay, so how do we fix this mess? Well, the folks at the International Accounting Standards Board have an answer, and it's this brand new standard, IFRS 18.
Put simply, think of IFRS 18 as a massive software update. It's replacing the old standard IAS 1, and its entire mission is to bring some serious discipline to financial reporting. The goal? To make statements way easier to understand and, most importantly, truly comparable from one company to the next.
So how does it pull this off? Well, it really comes down to three huge changes. First, it totally revamps the income statement. Second, it creates strict new rules for those adjusted profit numbers. And third, it gives better guidance on how to group information. We're going to focus on those first two, because that's where the real action is.
All right, let's kick things off with that first major change, the complete overhaul of the profit and loss statement.
From now on, IFRS 18 says that all income and expenses have to be sorted into one of these 5 specific categories. The whole point is to neatly separate a company's main business, its operations, from how it finances itself and where it invests its money. It gives you a much clearer view of where the profits are actually coming from.
Now, this isn't just shuffling deck chairs. This new structure forces a much clearer story about performance. By splitting out the core operations, it basically creates standardized checkpoints for everyone to see.
And here's the real game changer. IFRS 18 introduces 2 new mandatory subtotals that every single company has to show. First, operating profit or loss, and second, profit or loss before financing and income tax. For the first time, we're going to have these standard, comparable benchmarks across the board.
Okay, let's get to the second part, which honestly might be the most talked about change of all. We're talking about the new rules for those adjusted profits that companies love to put in their headlines.
So IFRS 18 gives these metrics an official name, Management Performance Measures, or MPMs. Just think of an MPM as any custom profit number that a company cooks up and uses in places like press releases to tell its own performance story, a number that isn't officially required by accounting standards. So to be super clear, what are we talking about here? Things like adjusted operating profit or profit before one-off restructuring costs. Those are classic MPMs. But, and this is important, things like free cash flow or ratios like return on assets, those are not MPMs, so they don't fall under these new rules.
So here's the kicker. Companies can still use these custom metrics, but, and this is a huge but, they now have to show their work. They have to put it all in one single note, explain why they think it's helpful, show you the math, and, here's the most important part, show a reconciliation back to the nearest official IFRS number. No more black boxes.
Now you might be thinking this is all just for the accountants, right? No way. These changes are going to create some serious ripple effects, touching everything from a company's IT systems all the way to how they talk to investors.
And don't let that 2027 date fool you. Because companies have to show their 2026 numbers as a comparison, the prep work for this needs to start, well, basically now. The clock is definitely ticking.
So, after all that work, what's the payoff? It's huge. For investors, you get the transparency and comparability you've been asking for, which should lead to more trust and better decisions. And for companies, it's a chance to tell a more credible story about their performance, one that's actually backed by clear, standardized data.
But let's be real, this is a heavy lift. Companies have to update their core IT and ERP systems. They're going to have to totally re-engineer their chart of accounts, which is like the financial DNA of the whole company, to fit these new categories. It is a massive project that's going to take real investment in tech, training, and planning.
You know, I think this quote from Larissa Clark at EY just absolutely nails it. At the end of the day, the goal is to close that gap between the official, audited numbers and the story that management tells investors, so we all get one single, coherent picture of how a company is really doing.
Which leaves us with the big question, right? With a new structure for financial statements and real discipline for those custom profit numbers, will IFRS 18 finally let us get the full, unvarnished story behind the numbers? I guess we'll find out come 2027.